Good morning, everybody. Hello, and welcome back to another edition of your Bitcoin Economic Calendar. I'm Mauricio Di Ortolomeo, co-founder of Ledn, and as with every Tuesday morning, we bring you the news and analysis you need to start the week off right in Bitcoin. Today is Tuesday, November the 30th, and we have a jam-packed episode for you this week. In today's issue, we're going to start by talking about the big hands that have been buying the Bitcoin dip this time around. We're going to break down who they are and some of the transaction details. Second, we are going to look at how investors are positioning their portfolios to close out the year and try to gain some insights there as to what we could potentially expect between now and the end of the year. And last but certainly not least, we're going to take a look at the US economy where signs of inflation continue to run wild. We're going to break down what sectors are seeing that type of inflation and again, what that could lead to between now and the end of the year. So grab your coffees, everyone. It's going to be a great one. And before we get started on today's show, we wanted to give an update for our savings interest rates as of December 1st. So starting December 1st, the interest rates on the savings account will remain the same. There will be a 6.25 APY% interest on the first tier of Bitcoin savings accounts. That first tier is moving from 1 Bitcoin to 0.5 Bitcoins. So the first tier interest rate remains the same. The size of the first tier moves from 1 Bitcoin to a half a Bitcoin. Balances above half a Bitcoin continue to earn 2.25% APY. And for our USDC savings account, the interest rate remains at 9.5% APY for all balances. As you know, we pride ourselves in offering market-leading rates while ensuring that the same rates are sustainable for the long-term benefits of our clients and our business. In addition to this, we also wanted to highlight that today is the last day to participate in the 1 Bitcoin giveaway as the month of November winds down. The full details of that contest are in our website. Some conditions apply. And we will also be announcing the winner of the 1 Bitcoin giveaway this week through our social media. So stay tuned for that one. Lastly, we also wanted to share that for the month of December, our referral program will increase from 10 USDC to the referrer and the referee to 50 USDC to each the referrer and the referee. This means that when you refer a client to Ledn and he or she funds their account, both of you can receive 50 USDC. Conditions apply, and you can check our terms and conditions for full details on our website. Onwards to our analysis. So starting as we usually do with Bitcoin, we see that it had a very volatile Thanksgiving week, dropping by almost 11% on Friday, but bouncing back over the weekend to close the week down just 2.28% at $57,338. As you can see, and let's just pop up the daily chart so that we can appreciate this a little bit better. As you can see, this was the big nasty drop on Friday. We made up ground over the weekend. We pretty much made it all the way back throughout the weekend. And we're seeing it come under pressure this morning after it had shown some continuation to the upside. But there's been some interesting news flow coming out of the Fed with Powell announcing that they might be accelerating the pace of the tapering process. This has equity markets in the US and Bitcoin this morning under a little bit of pressure. We'll continue to see how this evolves. As we described last week, the price action that we saw yesterday on Monday as people came back from the Thanksgiving holiday could be very telling as to how U.S. investors are positioning their portfolios to close out the year. And to reference that for a second, we wanted to pop up the recent options flow for Monday. This was yesterday. This is the options flow for this morning, which we're also going to look at and see if it's changed, if any. So right now we're seeing more put sells than puts being bought. This is the same as it was yesterday. And this is actually typically a bullish indicator as more people are selling downside protection than those who are buying downside protection. As you can see today on the call option side, it looks pretty even with not equal number of buyers as sellers. And actually yesterday, the options flow for Monday was showing a significant higher number of call buys than people selling calls. So these are people that are looking for upside, the people who are buying them, and the people who are selling them are people who see limited upside. So the fact that there are more people wanting to buy them than to sell them is also a positive indication. So again, both what we're seeing in the put contract options flow and the call options contract flow, that is typically seen as bullish positioning. So you could be seen as some of these option investors are positioning their portfolios for a potential rally from now until the end of the year. Some of the optimism around these recent purchases could be stemming from the conviction that is being displayed by some big hands like MicroStrategy, who announced on Monday yesterday that they had bought the dip yet again. Here are the details of their purchase. We're going to break those down in a second. But Mr. Saylor's company purchased an additional 7,002 Bitcoin to add to their stack. They now hold 121,044 Bitcoins worth around $3.6 billion. And their average purchase price on those is $29,534. So they're doing quite well given the current prices. Another big hand that made the news last week was none other than Morgan Stanley, as the news broke that their collective funds have been accumulating Bitcoin through units of the GBTC, the Grayscale Bitcoin Trust. As per a filing from last Tuesday, Morgan Stanley revealed that they had increased their GBTC positions across a series of funds that they hold globally. In the last 3 months, Morgan Stanley funds have collectively added more than 2,648,000 units of GBTC, which amounts to a fresh new holdings of $121 million over the last 3 months. The fund now collectively holds $303 million. So you can see it's a big step up from what they had, almost 40 to 50% increase over the last 3 months. And these are Morgan Stanley investors that are looking for exposure to Bitcoin through these funds. So if we look at that, we see that some big hands apparently are coming in and buying this dip. The data on chain, and this was a great chart shared by Pablo Henman last week. On-chain data for Bitcoin actually is consistent with these headlines. As you can see from this chart, it lists the price compared to the number of addresses holding over 100 Bitcoin, which is a significant chunk of change. As we can see, the number of wallets holding over 100 Bitcoin has been drastically increasing as the recent dip has progressed. So that's very interesting. And another great chart that was shared over the weekend, this one credit goes to Rational Root, basically gives us some framing as to where we could be relative to previous halving bull market cycles. And as you can see from this chart, previous cycles have also seen a dip or a correction before ending up the rally with a very strong run. The chart above suggests, or the chart in your screens right now, suggests that if history rhymes, we could be entering a few good months for Bitcoin in terms of price. A little bit more on Bitcoin on our What's Ahead section later today, and obviously throughout the rest of the sections. Moving over to the S&P 500 and U.S. equity markets, we see that it was a wild week as well for U.S. equity markets. Right now we're looking at this chart on the daily view. Let's pop out the weekly so we can see. So last week we see that the markets dropped significantly last week. Most of this came on Friday, and the S&P closed last week down 2.52%. At 4,583 points, which is quite a significant drop for the S&P 500. We saw that there had been some strong rebounds actually as of yesterday, and some of that this morning. But we just saw, as we shared earlier, the news came out that Fed Chairman Powell essentially stated that they might be accelerating the pace of their tapering program, which basically reversed the rebound entirely. And we're going to get into that actually in this section as to why the Fed is impacting the markets in such a way. We'll get into that at the end of this section. But looking at the price action, we saw that Monday, as we mentioned here last week, the positioning of investors had on Monday coming back from Thanksgiving holiday could be very telling as far as what they were looking to do or their expectations between now and the end of the year. What we saw yesterday, Monday, was that the markets got bid to the point where they almost completely erased Friday's losses. The big difference, and the reason that things are not the case, not the case any longer this morning, is this news out of the Fed, which is essentially saying that rates are going to increase much faster than the markets expected. So we're going to get into that in a second, but it feels as though the price moves that we saw on last Wednesday and last Friday look to be a bit of a turkey shakeout. Despite the panic selling from Friday, investors could have reflected on the fact over the weekend that inflation could eat away their portfolios, and they'd rather be in stocks that feel overpriced instead of holding cash. The news this morning out of Powell could have struck a little bit of fear on these investors, basically saying the Fed is not shy in stating that if they need to move faster, they will, to kind of prevent things from overheating. So this might have some people reconsidering that this morning. But right now, the prevailing problem seems to be that people just have quite a bit of cash and they don't really know where to put it. But what they do know is that they don't want to be in cash. And so it's an interesting conundrum that we're seeing in the U.S. Speaking of the U.S. and inflation and this idea that there's just way too much cash in the system, there have been a few red flags that basically point towards continued asset price inflation in the U.S. and food price inflation in the U.S. One of these great examples is what we're seeing in the U.S. real estate market yet again. We've been covering this quite a bit, but it's very interesting to see what's happening there. According to the most recent pending home sales report from yesterday, pending home sales jumped by 7.5% for the month of October. The median analyst estimate was for an increase of 1%. So the reality is basically saying that pending home sales are up more than 5x what analysts expected. And this is the headline that you see around that on your screen. Further onto this headline, it shows that demand for properties continues to soar and the supply for properties continues to dwindle. If pending home sales are any indication, the real estate market will remain very hot to end the year. On a different but related note, we're going to put up this headline here. Last week, Senator Elizabeth Warren called for a probe into turkey costs as prices of turkey have soared in the U.S. leading up to Thanksgiving. Naturally, if you can't have turkey on Thanksgiving dinner, people aren't going to be happy. And so the politicians are trying to jump right in front of this and basically take ownership of that narrative. While the irony of printing trillions of dollars, injecting them into the economy, and later complaining about rising prices is poetic, what is not so pretty is the fact that probing rising food prices is typically a forebearer of more inflation to come, not less. This is the type of fear that drives people to pile into the stock market and the housing market to protect the purchasing power of their savings. As we just said, investors don't really know where they feel most comfortable putting their money right now. They just know that they have a lot of cash and that they don't want to be in cash. And so it's a fascinating conundrum as they try to find places where they can essentially invest this to maintain their purchasing power. To highlight just how tight the correlation between fresh new money and economic prosperity is, consider the following graph from the Fed. And this graph essentially shows that the S&P 500 or markets in general tend to rise when the Fed's assets rise. The Fed's assets grow as it prints money and purchases treasury bonds from the US Treasury, effectively lending cash to the US government. So as you can see, when the Fed is threatening to alter the course of the growth of their assets on their balance sheet, this is what got the jitters in the market this morning based on Powell's comments. Moving over to gold, we see that gold dropped quite heavily last week, down 2.91% at $1,791 per ounce. And while many other assets bounced back to recoup their losses on Monday, gold did not. As we can see here, it's continued under pressure throughout the week. It didn't really see very much relief on Monday like did many other assets. There's a few headlines around gold, not a lot of earth-shattering information being shared here. But essentially, the headline out of Reuters says that gold eases its price as investors assess Omicron impact. This in some ways can be kind of linked to the potential COVID, maybe linked to like a short-term limitation of inflation. But eventually, if this virus does what others did, as the economy sort of comes to a halt, likely there will be the pressure to inject new money, and this might just be like a short-lived burst of subdued inflation. Now, again, speaking on that, while gold has typically been seen as a good inflation hedge, there are a few trends in the markets working against it right now. One of them is the US dollar, which just continues to strengthen. It's been quite a massive rally on the US dollar. And again, this impacts all commodities, all international trade. And as we can see, the dollar is up basically 4.5% since the beginning of September, which is a massive number when that's the price of all your inputs for your businesses. Separately, the yields on US Treasury bonds also dropped significantly. And this has been largely on the back of fears of the new COVID variant. Interestingly, we see that Powell made his announcement saying that they're going to move even faster on rates, but yet we are seeing bonds get bought and the rates actually drop, which is not what you would expect to see given what you are seeing in the markets. So again, very interesting. It seems as though the markets, the equity markets, are reacting to the fact that interest rates could rise faster than usual, yet interest rates themselves are actually selling off on the news. So very fascinating. If we had to bet, typically bond markets are more informed around interest rate moves and such than equity markets. So we might see one of them bounce back. Likely it'll be the equity markets or the bonds. We'll stay tuned, and we'll keep you updated on how this continues to unfold. Moving over to our DeFi section, we see that it was also a roller coaster week for the DeFi index and Ethereum. The DeFi index finished the week down 8.27%. But interestingly, Ethereum was actually one of the few assets that closed last week in the green, finishing up 82 basis points at 4,300 and up this morning, significantly up for the week still, 5.67%. So it closed last week over that important 4,000 mark at 4,300, and this morning it's trading north of 4,500. As we have highlighted here in the past, and we just want to take a second here to speak about a sort of broader topic around DeFi and alternative assets. As we've highlighted here in the past, the recent rally or the recent price action that we're seeing in the crypto markets has favored layer one protocol assets like Bitcoin, Ethereum, and Solana. And second layer tokens such as Compound, Aave, and Uniswap have been out of favor. Just for you to have a reference, here's the chart on the Comp token, far away from all-time highs. Here is Uniswap, again, not as far away from all-time highs, but still considerably away from its all-time highs. Aave, again, considerably away from its all-time highs, just based on what we've covered. To talk about the difference between layer one and layer two protocols for a second, if we take an efficient market hypothesis view on tokens and realize that most of these tokens don't give the token holder any legal rights on any legal assets, it is easy to think that these tokens' value is set to go to zero. Over the last 6 years, we have seen that while the names of the tokens and the projects have changed, there continues to be a thriving market in alternative tokens. Again, while this may not make sense from an efficient markets view, it may make more sense if we reframe our view of the activity. The first casino in human history was created in the same century as the first stock market. One could argue that stock markets provide more positive externalities to a society than a casino. Throughout history, Humans have willingly walked into a casino and gambled their money away, knowing that the odds were stacked against them. Under this lens, the fuel that keeps these tokens or these token markets going is greed. And if that is a fire, and that is a fire that has been burning throughout history. So much so that societies have had to step in to rein in some of the negative externalities of people's desires to gamble. So if we take the view, an efficient market hypothesis view on tokens, then yes, of course, they should all go to zero, given that they really don't hold, many of them, the majority of them don't hold any legal rights to anything. However, if we take a look at them as a speculative, more like a gambling type of activity, well, then there's been no shortage of people throughout history they're willing to bet their life savings on red. So just something to consider as we frame our view on some of these alternative tokens. Moving over to our Bitcoin mining difficulty commentary, the most recent adjustment came into effect last Sunday, dropping difficulty down by just 1.49% to 22.34 terahashes. This is the first negative difficulty adjustment since July of this year when the Chinese crackdown ended. However, it makes sense as we have now regained almost all of the hash power that was deployed back in July. Adding additional capacity may take more time, but all signs point to continued healthy growth in the hash rate. The mempool, taking just a quick peek, as we can see, continues to be clear. Transaction processing times and costs continue at optimal levels. Now, as always, we leave you with what's ahead for the week. Yesterday, Jack Dorsey announced that he would be stepping down as the CEO of Twitter. Why this is important is because he is still acting CEO at Square, which is heavily involved with Bitcoin and has announced many Bitcoin native initiatives. Jack could be transitioning to focus entirely on building Square and contributing to Bitcoin adoption. Most of Square's Bitcoin related projects, as announced, are scheduled to be open source. This could provide the infrastructure for entrepreneurs around the world to bootstrap new projects and liquidity for Bitcoin. This will be a fascinating journey to watch, and we wish you the best, Jack. As always, we wrap up with a summary of the upcoming economic data and earnings reports for the week. The feds are out in the street again. Fed officials are out basically giving speeches. And as we mentioned, it's been pretty active this morning already with Powell's notes. We're going to break down some of the additional commentary that we're seeing today. So today, actually, 9 a.m., we just saw it earlier, the Case-Shiller Home Price Index for September comes out. In the month of August, prices of U.S. homes were up 19.8% year over year. And given the recent number that we just saw on the pending home sales, it would not be surprising to see an even larger increase for September. 10 a.m. today, we just saw the commentary that came out of that. Fed Chair Jerome Powell and Treasury Secretary Janet Yellen are testifying on the CARES Act to Congress. At 1 p.m. today, Fed Vice Chair Clarita and Cleveland Fed President Mester are scheduled to give a speech. Tomorrow, Wednesday, 8:15 a.m., we get the ADP employment report, a look at the U.S. labor market. Expectation here is for an increase of 450,000 new jobs. The previous month had generated 571,000 new jobs. It will be interesting to see if growth in the U.S. jobs market starts to taper. 10 a.m. Wednesday, again, Fed Powell tomorrow, Chairman Powell and Secretary Yellen will continue to testify in Congress. So some more of these headlines could be coming tomorrow. And Thursday, Atlanta Fed President Raphael Bostic speaks on housing prices, very timely. I'm sure he'll have a lot to talk about. At 11 a.m. Eastern, Fed Governor Randall Quarles gives the parting thoughts at a conference. And at 11:30 a.m. Eastern Thursday, we get Fed President Mary Daly and Tom Barking speaking on the labor market. So again, the Fed is out in full force trying to get ahead of that narrative. 8:30 a.m. Eastern, non-farm payrolls in the U.S., similar to the ADP employment report, expectation is here for a growth of 581,000 jobs. This would mean an increase. So this could mean that job growth in the U.S. is actually accelerating in an already tight labor market, which would be a good sign. At 8:30 a.m. Eastern, we get U.S. unemployment rate. And the expectation here is for an employment rate to drop to 4.5% from 4.6%. 8:30 a.m. Eastern, average hourly earnings for the U.S. workers. Expectation here is for a 0.4 month-over-month increase, representing an annualized rate of 4.8%, which is well below the rate of inflation as per the CPI, north of 6%. 9:15 a.m. Eastern on Friday, St. Louis Fed President James Bullard caps the week off with a speech. That wraps up our show for today. It was a big week, or it is a big week as always, and we'll continue to keep you posted right here and through our social media. If you enjoyed today's show, if you learned something, if you like it, I welcome you to subscribe to our channel, like the video, and share it to your friends and family. If you don't yet have a Ledn account, I welcome you to check us out and learn how you can start earning up to 9.5% APY on your USDC and up to 6.25% on that first half of Bitcoin. We also have the best rates for loans if you have Bitcoin, need liquidity, but don't want to sell your stack. Thank you, everybody. Have a wonderful week and see you next time.